breaking news from the United States, where Donald Trump has announced Australia will be impacted by a 10% tariff on all goods imported into America.
Global stocks are this morning in free fall following US President Donald Trump's tariff announcement.
The president singled out Australia during his Rose Garden event.
They banned American beef, yet we imported $3 billion of Australian beef from them just last year alone. They won't take any of our beef. They don't want it because they don't want it to affect their farmers. And you know what? I don't blame them, but we're doing the same thing.
But Australia has been closed off to US fresh beef since 2003. The US argues the biosecurity requirements are now negligible.
Hey everyone, it's Scott here, and in this video, I'm going to break down for you the impact of the Donald Trump tariffs on you, your finances, your property, your mortgage, your interest rates, and ultimately your financial future. Let's break it all down now. Just here at the beautiful Barangaroo Point in Sydney, there's the beautiful Harbour Bridge. Out in the background, everyone out here enjoying this beautiful spot. So the Donald Trump tariffs, what is going on? So Donald Trump has just announced at his Liberation Day, where he is slapping tariffs on countries all around the world. And basically what tariffs are is like a tax on the importers in America. So the importers in America, when they import products and services from overseas, here from Australia, from Asia, from Europe, when they're imported into America, they've got to pay a tax on those goods and services before they sell them to the consumer. Now, these tariffs range anywhere from 10% all the way up to 70% in some cases. And I've got a chart here to show you all of the countries, the approximate tariffs that they will pay. Now, you'll see here that Australia has actually been slapped with a 10% tariff. In comparison to other countries, this is very small. However, there are two main impacts on Australia from these tariffs. There are the direct impacts, which are the tariffs on our exports to America. And then there are the indirect impacts, which all of the other countries all around the world who are our trading partners, the impacts of the US tariffs on their local economies and how the impact on their local economies is going to affect our trading patterns and our exports with them. So let's break it down. First of all, let's look at the direct impacts. So 10%. Now, we only have about $15 to $22 billion worth of exports going to America. And so the impact is not going to be that great. Here's a list of the industries that we do export over to America, and all of these services are going to have a 10% tariff on them. Now, the question that everyone asks me is, will these tariffs stand? Will they stay in place? Well, let me just explain for a moment. These tariffs have been enacted by Donald Trump as president of the United States under his emergency powers. You see, under the Constitution of the United States, the president cannot enact new taxes on the American people or new taxes at all. And therefore, he actually needs to get permission, or he needs to have a vote to go through the House of Representatives and the Senate. They need to approve it before you can have new taxes. So how has Donald Trump added these new taxes? Well, he enacted emergency powers. He declared the trade imbalance that America has at the moment as a national emergency, and under his national emergency powers, he can act a little bit like a dictator and slap these taxes on the American people and countries around the world without anyone's permission. Now, there is a battle at the moment in the House of Representatives and the Senate to overturn this. So this will be argued, debated, possibly taken to the courts, possibly taken to the Supreme Court. All of this will be decided in the next 60 days, and we will see whether or not the American House of Representatives and the Senate will fight against this and overturn this, or whether or not these tariffs will stand. However, I do see these tariffs standing if the rest of the world do not come around and negotiate with Donald Trump to lower trade barriers and tariffs on American goods and services. So at the end of the day, the direct impact is not going to be that great. There are some good industries here in Australia that will be impacted, but they will be able to find their way around this. They may still be able to get the services over there, even with the tariff. In 60 days, it may or may not be overturned, but this will not be a major impact on the everyday Australian. So now let's talk about the indirect impact. Now, the indirect impact is the one that we've really got to look out for. Now, Australia's wealth is built upon our exports. We export food, energy, we export education, and all of the wealth that we enjoy here in this country is built on the back primarily of those exports. So who are our main trading partners? Well, here's a list of our main trading partners, the percentage roughly of what they are, of all of our exports, and also in dollar terms, how much they are worth to the Australian economy. And as you can see, we are deeply linked to Asia, China. We are deeply linked also to Europe. Now, as you can see, I'll bring up this chart again of the tariffs slapped on all of our major trading partners. These tariffs could substantially negatively impact their local economies because many of their local economies, look at China for example, they are also built primarily upon exporting to the United States. So just as an example, China, without the ability to export to the United States in the volumes of which they have been used to, their economies will slow down, potentially move into recession. Now, if China is in recession, and if they're not ordering as many goods and services from Australia as what they have been used to, then that will reduce the amount of exports that Australia has and the income that Australia will actually have from that trading relationship. That will then mean that potentially our economy here in Australia could slow or even go into recession. So let's say the worst case happens. Let's say that China and our other trading partners cannot find new markets for their goods and services, and they cannot negotiate with America to reduce or eliminate these tariffs. What will actually happen? Well, Australia can respond in three main ways. So number one, we can reduce our interest rates.
I don't predict or preempt those decisions, but the market is certainly now expecting multiple interest rate cuts over the course of the year, beginning in May.
Australia can reduce interest rates by 1 or 2% to stimulate local demand and local economic activity to make up for reduced exports, thus maintaining our GDP. And when we do that, what it's going to mean is that all the assets here in Australia are going to increase. You're going to see house prices rocket forward because we are still in the midst of a housing supply crisis. In addition, we're going to see more inflation, and with interest rates coming down and the ability to get debt to buy assets, what you will see is the value of debt substantially reduce over time. Now, I want to take a little bit of time to explain that to you because, for example, if you take out a loan for $1 million and over a 10-year period, we are averaging 2 to 5% inflation in the economy, that means that the value of the dollar is reducing by 2 to 5% every single year. That means the value of your debt is reducing by 2 to 5% every year. So in essence, if you've got a $1 million loan today, there's 5% inflation every year for 10 years, then you've got 50, 60, 70% reduction of the value of that debt over that 10-year period. This is one of the tricks of the wealthy. They understand that debt erodes over time, and they understand that inflation is working into assets to increase them and against debt to reduce it. So when you take on debt, especially when you only need a 10% deposit in residential property, and that's why I love residential property, because it's one of the safest, most predictable ways to access debt and hold debt for the long term and ride the inflation wave. So number one, that's interest rates reducing. Number two, government stimulus package. So our government can actually print money or borrow money from itself. This is the government going to the RBA. The RBA has the printing press. The RBA can print up money, and then the RBA can then give that money to the government, and we can spend it into the economy. Now, this will cause inflation. In fact, this is one of the primary reasons why during the whole COVID thing, there was global inflation and also local inflation here in Australia, because central banks all around the world printed money and forced money into the economy through handouts, through helping businesses, helping individuals, writing them checks, giving money to the banks. So with all of that additional money running around the economy and constraints on supply, we did see record levels of inflation in the last 10 to 20 years. So yes, we can stimulate the economy through stimulus package. We can print more money up and spend that money into the economy. That will get us through a 5 to 10 year period. And in fact, that will again drive asset prices because it will cause inflation, and it will also reduce the value of debt. Now, number three, the government can continue high levels of immigration. Now, when our economy has suffered, whether you go back to World War II, whether you look at the GFC or recently with COVID, we have always brought in a large amount of immigrants, skilled, cashed up immigrants, to be able to boost our local economy. And if this goes down, if these tariffs remain in place, and if global trade reduces, if our trading partners suffer recessions or slowdowns, and we want to stimulate our local economy, we will need and we will have to continue excessive levels of overseas immigration to boost our population and to boost our tax base. This is because in Australia, we have committed billions of dollars of public spending for Medicare, for NDIS, for education, for social welfare. The commitments are huge, and they're huge into the future. And currently, our current budget is in deficit, and we're expected to have a budget deficit over the next 5, possibly 10 years. Therefore, if we do not continue to grow our tax base through a larger population, then we will not be able to meet our financial commitments that we have promised at each and every election. So what are the key takeouts for you? Well, the key takeout is this: Australia, no matter what happens, is going to be fine. If the worst case does happen, we have 3 things we can do to keep our economy and our prosperity going. And those 3 things, if they are done, are only going to accelerate asset inflation, residential property and other assets, and also accelerate inflation, the devaluing of our dollar, but also the devaluing of your debt. What does this ultimately mean? It means those that hold residential property over the next 5, 10, 15 years are going to become exceedingly wealthy. Now, even if these tariffs stay in place, these countries can find other ways to keep their GDP and their economies going. Number one, they can actually get their local consumers to consume more and generate more in the economy. They can do this through restructuring their local economies, maybe restructuring the way taxes are actually taken. They can lower taxes, which can increase local expenditure, which overall can create more economic activity, keep more people employed, and actually generate more tax if the economy is actually growing, because there'll be a larger economic activity for them to be able to tax. So therefore, these tariffs could trigger the re-engineering of economies all around the world to become more capitalistic in nature, to encourage more consumer spending. In addition to that, these countries can form stronger links with each other and actually not look to the US to be their main export destination, but actually find other export destinations. And again, if the rest of the world does re-engineer and restructure their local economies, their labor markets, free it up, become more capitalistic, then there can be more consumer activity in those countries, because right now, because there's such a free capitalistic economic structure in the US, they are the world's #1 consumers. Why do we not consume so much in other countries? Because many of them have socialist policies and high taxes, which reduces the amount that those local consumers can consume, and therefore lessens the amount of exports they need from overseas. But this can be recreated in other countries, either domestically in their own country, for example, China, or actually with other trading partners.